Hello and welcome to General Knowledge Lecture Series. Today's topic is Indian financial markets. In this lecture, we wish to understand the different types of financial markets in India, their concepts and their functions. Along with that, we would also discuss stock exchanges in some detail. So let's begin our video. We know that money always flows from surplus to deficit. That means persons having access of money lend it to those who need money to fulfill their requirement. Similarly, in business sectors, the surplus money flows from the investors or the lenders to the businessmen. So, we find two different groups, one that invests money or lends money and the others who borrow or use that money. Now you think how these two groups meet and transact with each other. The financial markets act as a link between these two different groups. It facilitates this function by acting as an intermediary between the borrowers and the lenders of money. Financial market consists of individual investors, financial institutions and other market intermediaries. Financial market provides the facilities for interaction between the investors and the borrowers. This interaction leads to determination of price of the financial assets between the investors and the borrowers. The financial market also provides security to dealings in financial assets. It ensures liquidity by providing a mechanism for an investor to sell the financial assets. A financial market consists of two major segments, money market and capital market. While the money market deals in short-term credits, the capital market handles the medium-term and the long-term credits. Let us discuss these two types of markets in a little more detail. The money market is a market for short-term funds which deals in financial assets whose period of maturity is up to 1 year. It should be noted here that money market does not deal in cash or money as such, but simply provides a market for credit instruments such as bills of exchange, promissory notes, commercial papers, treasury bills, etc. These financial instruments are close substitutes of money. These instruments help the business units, other organizations and the government to borrow the funds to meet their short-term requirements. Money market does not imply to any specific marketplace. Rather, it refers to the whole networks of financial institutions dealing in short-term funds, which provides an outlet to lenders and a source of supply for such funds to the borrowers. Most of the money market transactions take place on telephones, fax or internet. The Indian money market consists of Reserve Bank of India, commercial banks, cooperative banks and other specialized financial institutions. The Reserve Bank of India is the leader of the money market in India. Some non-banking financial companies, which is NBFCs, and financial institutions like LIC, GIC, UTI, etc. also operate in the Indian money market. Let's look at some of the major instruments or securities that are transacted in the money market. Call money is mainly used by the banks to meet their temporary requirement of cash. They borrow and lend money from each other normally on a daily basis. It is repayable on demand and its maturity period varies between 1 day to a fortnight. The rate of interest paid on call money loan is known as call rate. A treasury bill is a promissory note issued by the RBI to meet the short-term requirements of funds. Treasury bills are highly liquid instruments. That means at any time the holder of treasury bills can transfer or get it discounted from RBI. These bills are normally issued at a price less than their face value and redeemed at face value. So the difference between the issue price and the face value of the treasury bill represents the interest on the investment. These bills are secured instruments and are issued for a period not exceeding 364 days. Banks, financial institutions, corporations normally play major role in the treasury bill market. Commercial paper or CP is a popular instrument for financing working capital requirements of the companies. CP is an unsecured instrument issued in the form of a promissory note. This instrument was introduced in 1990 to enable the corporate borrowers to raise short-term funds. It can be issued for a period ranging from 15 days to 1 year. Commercial papers, that is CPs, are transferable by endorsement and delivery. The highly reputed companies, blue chip companies, are the major players of commercial paper market. Certificates of deposit. Certificates of deposit, CDs, are short-term instruments issued by commercial banks and special financial institutions, that is SFIs, which are freely transferable from one party to the another. The maturity period of CDs range from 91 days to 1 year. These can be issued to individuals, cooperatives as well as companies. Moving to the capital market, this is a market for raising long-term funds, that is 1 year or above. In the beginning, the banks were the only source of long-term funds. So, banks were the first players in the capital market. With the passage of time, many other segments were added to the capital market, like insurance industry, mutual funds and security and stocks market. Therefore, capital market is a wider term than security market or stock market. Security market refers to the market where financial securities are traded. The securities market has two interdependent and inseparable segments: primary market or the new issue market and secondary market or the stock market. The primary market provides the platform for the sale of new securities. When the security is traded for the first time, it comes in the primary market. This process is known as IPO, which is initial public offer. The issuer of the securities, that is the company, sells the securities in the primary market to raise funds. Therefore, in primary market, the transaction takes place between an issuer and an investor. The secondary market deals in those securities which have already been issued in the primary market. The secondary market enables those who hold securities to sell these securities to those who want to purchase. Therefore, in the secondary market, transactions take place between one investor and another investor. An active secondary market facilitates the growth of the primary market, as the investors in the primary market are assured of a continuous market for liquidity of their holdings. The major players in the primary market are merchant bankers, mutual funds, financial institutions and the individual investors. And in the secondary market, you have all of these and the stockbrokers who are the members of the stock exchange who facilitate the trading. Let's now try to understand the major point of difference between primary and secondary markets. The first one is function. While the main function of the primary market is to raise long-term funds through fresh issue of securities, the main function of the secondary market is to provide a continuous and ready market for the existing long-term securities. The second point of difference is participants. While the major players in the primary market are financial institutions, mutual funds, underwriters and individual investors, major players in the secondary market are all of these and the stockbrokers who are members of the stock exchange. Then comes listing requirement. While only those securities which can be dealt within the secondary market which have been approved for the purpose that is listed, there is no such requirement in the case of a primary market. Next comes the determination of prices. In the case of a primary market, the prices are determined by the management with due compliance with SEBI requirements for the new issue of securities. But in the case of a secondary market, the price of the securities is determined by the forces of demand and supply of the market, and it keeps on fluctuating. Let's also look at the distinction between the capital market and the money market. Capital market differs from the money market in many ways. Firstly, while money market is related to short-term funds, the capital market is related to long-term funds. Secondly, while the money market deals in securities like treasury bills, commercial papers, trade bills, deposit certificates, etc., the capital market deals in shares, debentures, bonds and government securities. The third point being, while the participants in money market are Reserve Bank of India, commercial banks, non-banking financial companies, etc., the participants in a capital market are stockbrokers, underwriters, mutual funds, financial institutions and individual investors. Fourthly, while the money market is regulated by the Reserve Bank of India, the capital market is regulated by the Securities Exchange Board of India, which is SEBI. Talking of stock exchange, a market where instruments of security market like shares, bonds, debentures, etc. are exchanged is a stock market. The first stock exchange in India, the Bombay Stock Exchange, that is BSE, was set up in 1870. At present, there are 26 stock exchanges in India. The two major stock exchanges include Bombay Stock Exchange and National Stock Exchange, which is NSE. Bombay Stock Exchange is the biggest stock exchange in India and fifth largest in the world after New York Stock Exchange, NASDAQ, Tokyo Stock Exchange and London Stock Exchange. Sensex or Sensitivity Index is the primary index of BSE. Sensex represents the Indian stock market. The index tracks the movement of shares of 30 blue chip companies. Talking of NSE, which is National Stock Exchange, it was set up in 1992 and became operationalized in 1994. S&P CNX 50, also called the Nifty 50, is a 50 stocks index of NSE. Moving on to SEBI, Security Exchange Board of India. It is a regulator of all the stock exchanges in India. SEBI was set up in 1988 and became a statutory body with the passage of bill in the Parliament in 1992. The current chairman of SEBI is Ajay Tyagi. The former regulator of commodity market, that is the Forwards Market Commission, FMC, has recently been merged with SEBI. With this, we have come to the end of this lecture, but you should keep revisiting this one and revising it until the next lecture. Happy learning to you. Thank you.